Welcome, everyone, and thanks for joining us for the session here with Marty, our certified financial planner. Lucas, let me turn it over to you and tell us a little bit about yourself and how you got into the financial planning business.
Yeah, thank you, Mike. Happy to be here today to kind of go through some information on looking at potentially trying to find, if you are looking for an advisor, what should we be looking at? What are some considerations, things like that? There's a ton of advisors out there. So we'll go, I only have 6 slides, to be honest with you. 2 of them are going to be introduction slides, basically, anyways. So I'll give you a little bit of background on myself. We'll kind of use up one of the slides. Actually, maybe I'll just share my, Mike, do you care if I share my screen and I just pull some of that stuff up here? Let me know if that looks okay on your side. Should be good, hopefully, on that. Okay, so let's see if it's going to go to. So my background is I'm originally from Monticello, Wisconsin. It's about half an hour south of Madison here. I grew up on a dairy farm. My mom was a teacher at the local high school. So I've always been a big fan of education. I've always wanted to kind of help people. I thought about being like a math teacher at one point in time, but I did not necessarily like dealing with kids and things like that in the school districts and on that side. So when my brother is a financial advisor, he's actually the president of WDS here. He asked for some additional help with his business. And when I was 16, I kind of interned with him for the first summer there once I got my driver's license and decided it was something that I really enjoyed and decided I wanted to go into this or pursue it a little bit more for my career. So after graduating high school, I attended UW-Madison. I got my bachelor's degree in personal finance. Madison calls it consumer science. I always call it personal finance because it's easier to kind of explain. And I also have a business certificate. The nice thing with the personal finance program is it was more geared towards actual working with people, individuals, things like that. So it was not in the business school at Madison. The business school is more corporate finance, some of that side of things there. So there's a little bit of difference on that end. And then I became a full-time advisor after I graduated in 2017. So 2024 here will be my the start of my 7th year being a full-time advisor, but I've been working with my brother here since 2012. So June will start my 13th full year in the business, in the industry on that side. Have my securities, life, and health insurance licenses on that end. But I'm not here to talk a whole lot about myself or any of that information, more so about the industry in general. So when we're looking at financial advisors, I have 3 things that I'm going to talk a little bit about. If you have questions on anything, when things come up, don't feel like you need to wait till the end of the session to ask those. I want this to be a little bit more informal, more conversational. People have questions, feel free to, whether, I don't know I don't know how you can tell me that you have a question unless you unmute yourself. You can do that. If you want to put it in the chat, I can always reach them in there as well. But I have this slide, and then I'll go through each of the 3 pieces here to kind of talk about when you're looking for an advisor, potentially looking for working with an advisor, what are some things that we should actually look for, consider, what do things actually mean? And the issue with financial advisors is our industry gets a very bad reputation because you hear all about all the bad apples, the people that are stealing clients' monies, doing things with super risky investments that are not suitable for what the clients are really looking for. And it makes it harder for everyone to trust financial advisors. We understand that. We feel like we hopefully do things the right way. But I understand that there's always going to be hesitancy from people trusting someone with a big part of their financial net worth potentially on that side. So 3 things that I'll talk about when considering and looking at financial advisors. I'll tell some stories and some background on each of these as well. But first one that we'll start with is advisor designation, some certifications to kind of think about. We'll talk about services that are offered by different financial advisors. And then the third one is a big one is how do those advisors actually get compensated? How do they make their money? All of those three pieces should factor into your decision on, if you are working with an advisor, which one should we pick? So I'll start with the advisor designations or certifications. So there's a ton of designations out there in the financial world. It can be very confusing on actually understanding what they all mean. I looked these up on the FINRA, which is the our industry's like regulatory body. They have like a list of a couple hundred different designations that people can get that all have different requirements and education and things like that in the big picture. But the two main financial planning designations that we typically see are the CFP, which is the Certified Financial Planner, and the CHFC, Chartered Financial Consultant. Those are the two big ones that you will see that a lot of advisors have. To be honest with you, they're relatively similar for the most part. The main difference is, so the CFP, that's actually what I have. You have to go to an accredited institution or a program that allows to count towards the education component of the CFP program. UW-Madison is a program on that end that actually qualifies. So getting my bachelor's degree was also able to double count as the education for the CFP. But the CFP, basically there's 6 sections of information that people have to cover. And then there's a cumulative exam at the end. So anyone that has a CFP is going to tell you that the CFP is better than the CHFC. If people have the CHFC, they'll tell you that that's better than the CFP. Either one of them are, like I said, totally fine. It makes sure that you're qualified to actually talk about the financial planning industry. But the difference with the CHFC, that's more so for people that did not go to college or go to school to be a financial advisor, to be in the financial planning area. Like my brother Jeff, he's the president of WDS. He went to Platteville. He's got his business administration degree, and then he joined John Hancock to be a financial advisor on that end. But his education at Platteville didn't qualify him to sit for the CFP, so he was able to take the CHFC, which is actually 8 sections of the class that they have to, or 8 different topics to go through. But they have a quiz or a test, exam, whatever you want to call it, after each and every topic. So they're a little bit different. The big thing is just making sure that you're working with someone that is qualified, understands that information. Again, there's a lot of other designations out there. You'll see like the CLU, which is a chartered life underwriter, things like that in the insurance industry. You'll see a SEMA. There's, like I said, there's hundreds of them out there. If you are working with someone, if they talk about it, might just be worth it to get a little bit more of an explanation of what actually went into it to get that designation. What does that certification actually result from? So those are important. But the last one that I want to talk about here is fiduciary versus the suitability standard. So advisors, they can typically work with people under 2 sides of things, the fiduciary or the suitability standard. And the suitability standard basically just means that the recommendations have to be suitable based on your financial situation, age, risk tolerance, goals, time horizon, things like that. Where the fiduciary standard basically makes them put their own interests aside and tells you that they're working in the client's best interest. So another big designation out there that you will see is the AIF, the Accredited Investment Fiduciary. That's another designation that I have, just to show the people that we work with, our clients, that we actually do work in our clients' best interest. We're not doing things on our side because it's going to make us more money. We're doing it because we believe it is in their best interest in the big picture. Just because someone doesn't have the AIF does not mean they're working in a fiduciary capacity. So I mentioned my brother Jeff. He started his career with John Hancock. For the investments, they were independent. He could be a fiduciary on that side. He can go and invest the money anywhere. He can do annuities. He can do whatever he felt like was best for the client. But since he worked with John Hancock, if anyone needed life insurance, he had to work with people on that side under the suitability standard. He could only show people John Hancock's $100,000 15-year term policy. So he's a little bit more restricted on some of the options that he could provide out there. It's John Hancock's policy might have been suitable. It could be exactly what that client, that person is really looking for. But that doesn't mean that there'd be other companies out there that could provide just as good of coverage with lower premiums, same financial strength as a business, things like that in the big picture as well. So that's another question to ask is, how do they work with their clients? Are they working under the fiduciary capacity? Are they working under the suitability standard? And how does that impact your situation on that end? But this is something you'll continue to hear more and more about. This is more, they're trying to shift more and more people over to the fiduciary standard. There was different legislation that was passed back when like Obama was in office. Some of it was kind of pushed through too quickly and didn't really cover exactly what they were wanting to do. So there may be additional regulation coming down the pipeline, kind of making people go more and more to the fiduciary standard as advisors.
Lucas, if I could interrupt here real
Yeah,
quick.
absolutely.
And anyone here, anyone, whenever you have a question, feel free to interrupt us and ask Lucas right away, if you prefer that way. I wanted to know, how do people know that, you can ask them, right? But yeah, just because you have AIF certification, does that mean that you're acting as a fiduciary for that person? Or are you just making sure it's suitable? You're selling gold bars to anybody with a wheelbarrow?
So if you have the AIF or the CFP, there's a board of ethics or a code of ethics that you are supposed to follow. I can't guarantee you that everybody follows those as they should. But if they were ever to come back and start to question some of the decisions, some of the recommendations that you're making, they would be able to come back and potentially revoke your CFP or your AIF and things like that in the big picture. So it's important to know that they have it, but it's also important to talk about it and make sure that they're actually working in that capacity. There's people out there that they say it could be suitable or it could be the best interest for the client, but that doesn't necessarily mean that that's what they truly believe on that end as well. So that's a great question, Mike. It's hard to verify one way or the other on exactly what they're doing. But there are code of ethics that us as advisors are kind of following on that side, that it's supposed to help reduce the amount of people that have the AIF but are not working in that capacity as well.
Okay, thanks a lot.
Yeah. Any other questions on designations, certifications, things like that in the big picture? No? Okay.
So I have a question. So someone can
Yeah.
be a planner who doesn't have that certification. And so they don't necessarily have to do the fiduciary.
Correct. Yeah, you technically don't need to have the CFP. You don't have to have a CHFC, any designation whatsoever to provide financial advice. You do have to pass a couple exams, like the series. There's different series with the 6, 7, 63, 65, 66, things like that, that people will have to pass to be able to have a license to buy and sell securities for clients, do the investing, things like that for people. But that does not necessarily mean that they have to get any other designation to kind of prove their education, that they understand what's going on or how they're working with clients. It's just something I would recommend looking for in an advisor, is someone that does have some of these designations, just so that way you're able to make sure that they are qualified to talk about what they're actually talking about.
Okay. Thank you.
Yeah. One story that I want to talk about, just with like the fiduciary versus the suitability standard, just to kind of illustrate the differences on these. So I was up in Minneapolis a couple of summers ago with a few of my friends for a golf trip, and we were out at a sports bar watching a couple of baseball games, and we ran into another financial advisor that had worked up there, and we were just chatting with her, and we were talking and kind of just comparing notes and talking about how we do business. And she told me that basically no matter what your situation is, if you are looking to make an investment, she's always going to sell you one thing. And it was going to be a simple SEP or some sort of an annuity on her side. And she could do that because technically it's suitable and it could work for that situation. But that does not necessarily mean it was the best option for those people and for their situation. So it's always something you want to make sure that you talk about with any advisor is how do they actually work? Do they have the flexibility of picking across different companies, or are they only able to use one or two different places for investments, for annuities, for insurance, things like that in the big picture, just because it really provides a lot more flexibility, and the more flexibility, the more options, typically the better you can do in the big picture on that end. But I will go to the next slide here. I want to make sure that we stay on time. But the next thing to consider with a financial advisor, anyone that you're working with, is it's very important to make sure that you understand what they can actually provide. People can call themselves financial advisors, investment and planners, insurance salesmen, things like that. All of them are different topics. And you want to make sure that you're looking for someone, working with someone that can actually provide what's going to make the most sense in your situation, what you're really trying to find. Because some people, like I said, will just do investment management. They don't do retirement planning. They won't talk to you about taxes. They won't talk to you about insurance. Some places will do the investment management, and then there'll be an additional fee for retirement planning. So it's really making sure that you are trying to find someone that's going to help you with the stuff that you want. We try to be as comprehensive as possible. This is not an exhaustive list of what advisors might offer, but like with our clients, we can help them with their investment management, and we have a big focus on retirement distribution planning, setting up their accounts so that way when they do get to retirement, how do we set this up in the best way possible to keep as much money in our own pocket? So part of that is by doing some tax planning. Some offices will have a tax advisor on staff that can kind of help with looking at doing, when you're taking the money out of the accounts, does it come from the pre-tax side of things? Does it come from the Roth? Should we be looking at doing Roth conversions? Things like that. That can be a super helpful additional value that some other places don't necessarily offer. Going back to the insurance side of things, like I said, are they able to go across different options in the big picture, or can they only sell you whole life? Can they only sell you universal life? Can they just do term? Because again, every situation is going to result in a different outcome. More options is typically better for the most part. We don't want to get too many options because then it gets to be sometimes overly complicated. But just making sure that you're able to find the stuff that they can help provide in your situation, whether it's tax planning, college savings planning. Big one is estate planning. So estate planning, you do have people that can be like financial advisors and estate planners. Sometimes that works. A lot of times advisors don't necessarily have the estate planning like background. A lot of times you need to have the education and go to law school to be an estate planner on that side. So if advisors don't necessarily offer it, you may want to ask, well, do you have other people that you work with or refer that business out to? Like us, we don't do any estate planning in-house, but we have a few different estate planning attorneys in the Dane County area that we can help refer people to. They don't give us anything to refer clients to them. We don't get a kickback or anything like that. We primarily are looking for people that will do a good job for our clients and get them what they want in the big picture. Other areas that they might offer is debt management, budgeting, inheritance, could be like health insurance. So if I think Mike, you mentioned that this program is kind of for people 55 and older. So some people will potentially need, like if they retire from their job before age 65, before they're eligible for Medicare, well, what do we do for health insurance from 59 to 65 or 62 to 65, whatever it may be? Some places can offer advice and guidance on that side. Other people will have like a Medicare specialist. So Medicare specialists, I'm sure as a few of you have probably found out, is Medicare is not always the most simple program to kind of figure out to see what makes the most sense out there. for your situation. So some people will offer a Medicare specialist that can kind of help walk through your situation, talk about, well, do you take a Medicare supplement? Do you do a Medicare Advantage plan? All that sort of stuff there. It's going to be very, very dependent on each and every firm and each and every advisor on what they are able to offer. And it may be nice to get people that are specialized in different areas. So like myself, I am not specialized in health insurance, but at our office here, we do have someone that does pre-65 health insurance. We have a Medicare specialist. I don't do tax returns. I'm not a tax planning advisor or anything like that, but we have someone on staff that can help with that and kind of specialize on that side of things there. So the other options that they provide outside of just, here, can you go and take my money that I have and invest it? There's other services that can be provided that will provide a lot of value and hopefully help you to obtain your goals, objectives in the big picture as well.
Lucas, let me, so, a lot of professionals are connected in referral networks, you said that you don't take a fee for a referral. How would a person know?
Oh, I think you muted yourself here, Mike.
Oh, I was talking and not making any progress here. So I was saying, how would a person know if a referral is being made based on someone getting a fee for that referral? I mean, that can, you see on TV, these law firms, their only business is to solicit names and then get a kickback when they refer those names to other firms. And so how could I know that the referral that you're giving me isn't based on or anyone, isn't based on you getting $500?
Right. So
how could we know that?
Technically, the advisors, people like that, are supposed to disclose any conflicts of interest. So if you are referring someone because I'm going to refer it to X, Y, and Z company over here because they pay me $100 for everyone that I shift over there, technically you have to disclose that. Again, that doesn't necessarily mean that everybody is doing that. It's hard. That's the biggest thing with our industry is, how can you guarantee that they're doing what they're supposed to be doing and what they're telling you is true? Part of it is you can't. There's no way, unless they were to get investigated, or if there's a way that they were what's the word I'm looking for? If they're listing that, they may tell you that they're getting a kickback, or they refer this way or that way because of a kickback on that side. But technically, I believe they're supposed to tell you and kind of disclose any conflicts of interest on that side.
And you can go to the last summer. I remember we had a really nice program with Leslie and Joe, who are on this call today. I can't remember the name of the tool that you use to check out whether a financial person has been had problems in the past, if they've been storytelling and caught.
Yeah. So I mean,
is that at FINRA where they go?
Yeah, so it's a FINRA Broker Check. You can go and you can look at you can look up the name, where they work at, and then they can pull up the information, see if there's been any like disclosures, if there's been any like fines or lawsuits or complaints issued against those advisors. It will tell you, even if a complaint was dismissed, it's still going to show up on that advisor's broker check. But that's another good tool to kind of just see what options some of these people have as well. It looks like Joe put that into the chat, the link for the FINRA Broker Check. So it's another great tool when you're kind of looking to see what people are able to do, to kind of see, well, if this is someone that has a bunch of complaints, it may not necessarily be the best person to be working with going forward.
That's one of those where you want your friends to be clean, have clean hands, right? So yeah. Great. And thanks, Joe, for putting that in there. I was trying to remember what that was. I mean, you guys provide so much good information last summer about this. And okay, Lucas, get to it.
Yeah,
sorry.
Absolutely. No problem. Good questions there. Like I said, if people have questions, let me know. I can drag this out as long as I need to, but if people have questions, I'd rather answer what people are looking for. because the last slide that I have, if it's going to let me go to the next one, is another big piece is to discuss with any advisors how they actually get compensated. So do they get paid when you put money in, when they buy something, when they sell something? Do they get paid on an ongoing basis? Again, are they incentivized to sell you certain things because of what it's going to do to their compensation? So very, very important to make sure that anybody that you are working with, you understand how they get paid. I'll talk about a couple examples here in a little bit, and you should be able to ask that question, and they should be able to very clearly explain to you how they are compensated. If they give you the runaround on, well, we get paid this way and it's kind of that way, and it's not very clear, usually that's a very big red flag on what they're actually doing. Again, some people will get kickbacks for using this fund or that fund or whatever it may be. They have to disclose that and tell you that that is part of their decision-making process for the most part. So a few different ways that people will, or advisors will get paid. So the first one is AUM. So this is assets under management. This is becoming more and more popular with advisors, that they charge a percentage of the assets that they're actually managing. They don't get paid any commissions right up front when you buy something, when you sell something, when you put money in, when you take money out. It's all on an ongoing basis based on the value of the actual investment account. So that way, this is a way that a lot of fiduciaries work with advisors or with their clients, because they have an aligned incentive that when you do better, they do better. A lot of times that percentage, it really ranges depending on the firm, things like that. Like our highest fee is 1.25. It goes all the way down to 0.25% a year. But that 1% fee is based on the account value. So if you have $1 million and you're getting charged 1%, well, we have an aligned incentive with you to try to make that money go from $1 million to 1.3 million. Because when things go up, you're going to be happy. But also, if things start to go the wrong direction, your $1 million all of a sudden becomes 600,000. I can guarantee you clients aren't going to be happy. Advisors aren't happy that are getting paid under the assets under management side of things, because now that 1% fee is charged on a much lower value. So their income goes down on that side. So this is how all of our advisors work with clients at this point. There are certain circumstances where the AUM doesn't necessarily make a lot of sense. I'll get into that here in just a little bit. But the AUM is a way to kind of make sure that the advisors are incentivized to keep an eye on the investments, feel like if they need to make changes that they do that, and they're not just making changes to create additional income for themselves. So that one, again, you want to make sure how that fee is charged. Sometimes they'll come right out of the account. Sometimes they will bill you for that. But you also just want to make sure that you understand what that actual fee is. Sometimes they try to hide that. It should be very clear. You should be able to get a very clear answer on how much the fees were for the last year, what was last month's fees, things like that. Sometimes they show up in the account statement. Sometimes that's something you need to ask the advisor for. Another one that people will do is like a flat fee based. You can charge either a monthly or annual fee for kind of just doing some investment planning. Whether it may not necessarily just be investment planning. Some people like to do their own investing for themselves, or they have some other advisor that does that for them already, but they want more planning, advice, guidance, tax planning, Roth conversions, things like that. Some people can kind of work with like an annual retainer type of arrangement, where you pay $200 for a meeting, or it's $2,000 for 5 meetings throughout the year, things like that. Those fees really will vary depending on what people are looking for. I have some people that come in and they get charged $500 for a meeting, and that's the only time we see them a year, because they send in information beforehand. We do the prep work behind the scenes. We bring our tax advisor, our health insurance person in. We do that meeting, and then that's the only time that we see them. We're not doing other stuff for them throughout the year. Some places will charge a investment management fee, as well as a retirement planning fee or a financial planning fee. So again, those are two different things that, again, you want to be very aware of. Well, what are those fees? What are they? When do I pay them? And what are they actually based on? The third one is commission based. So this is where a lot of people, a lot of advisors historically have worked more on a commission-based side of things, that they get paid when you invest or when you buy something new. So when you put the money in, the advisor gets paid a certain percent, certain dollar amount. Again, each and every place is a little bit different. But when you put that money in, they get compensated right up front. And then typically there's not a huge income on it afterwards. Some places will, like with annuities, some life insurance, things like that, will pay a commission up front to the advisor, as well as a trail, a small percentage each and every year after that, for kind of holding on to the annuity with the client there. And again, all of this depends on how that advisor is working. And you want to make sure that you understand how they get paid, because it may impact what some of the recommendations are. Because if they get paid based on commission, they may be pushing you towards something that would be a higher commission to them than what is necessarily needed in your situation. So again, that kind of goes back to the fiduciary versus the suitability standard as well. I talked about that advisor that I met up with back in up in Minneapolis a couple of years ago. And when I asked her, well, why do you only sell annuities? She's like, well, that's the only way I can continue to make an income. I got to find something new to sell or find someone new to invest with me, so that way I keep getting compensated, which is not necessarily the best way for people to work with their advisors on, because then again, it just creates that conflict of interest on, are you doing this because you think this is the best thing for me, or is this the best thing that you can recommend for me that's going to pay you the most money as well? So again, those are all conversations you should have with an advisor before trying to choose and pick, and making sure you're feeling comfortable with an advisor, especially any annuities or life insurance, things like that. A lot of those typically are high commission based products. So you just want to understand, how is this beneficial to my situation? And I'm not saying commission-based is wrong or anything like that. We work with all of our clients under the AUM or the flat fee-based arrangement there. We don't do anything commission-based, because we don't want that to cloud our judgment. We don't want to have an incentive to go this way or that way, just because it's going to pay us an extra 0.25% or 1% for this annuity compared to that annuity. But there are advisors out there that will work that way. That's how a lot of the advisors 15, 20, 30, 40 years ago were doing business, because that's really the only way that it made sense at that point, until we had some of these other options become available. So very, very important to have that conversation, understand how the advisor's compensated. Are they working in my best interest, or are they working again for what they want on their side? Questions at all on any of that?
Lucas, let me launch a little poll question here to see what people think of these various methods of compensation. Okay, just a second. And then maybe we can discuss that, because I'm wondering why somebody would choose commission-based, and yet that's probably the one that most people end up paying, right? So let me just send this out here real quick. If you would, please respond to the poll, everyone. Let's see which one of these you like better: assets under management, compensation, flat fee, or commission-based compensation for your advisor. Which do you like better? The more info we get, the better. And then let's see, what your reasons are for choosing these. Okay, looks like we got yeah, people are jumping in there. Great.
Where'd my slide go?
Yeah, where'd that slide go?
I'll go back. There we go.
Ah, there
Okay.
it is. There we go. Okay.
Right. And Leslie makes a good point there. In the chat, she said it kind of depends on the situation. And yeah, absolutely. There's times where it makes sense to do something commission if you're just going to buy and hold it for the next 30 years. There's no reason to pay an ongoing fee with that. It may make sense just to pay up front and be done with it. If you're not going to be buying, or if you're going to be buying and holding, probably makes sense to do it on that side. If you don't If you're not worried about making changes to it for 5, 10, 15, 20 years, the commission base will probably be cheaper for you in the big picture on that end. The AUM is more so for like an ongoing arrangement with the advisor kind of keeping an eye on things, making changes, whether it's monthly, quarterly, annually, whatever it may be on that side.
Yeah, good point. And Rebecca asked, will this recording be available? Yeah, and Lucas, could we put your slides along with that if someone would like to get a copy of the information you have on your slides? Yeah, just you send that to me and I'll get it out to people who want it. It's very interesting.
I can email it to you so you have that.
Terrific. Okay, so that's very interesting. Yeah, I hadn't thought of Leslie's point there. You know, I only need to pay that you know, little commission right now and forget about it. I'm moving on. I'm not paying you your $200 a meeting advisor charge, you know, so that's a great point. Yeah.
Right. So I have a question. So why should someone use a financial advisor?
So not everyone will need an advisor. I'm not going to tell you that every single person here needs an advisor. There's people that are more than confident to do that themselves, and are more than competent to be able to do it themselves. But the reason why a lot of people will hire an advisor is they don't want to deal with it. With the financial side of things, they want to make sure that they're not missing things or making mistakes that are going to impact their retirement in the big picture. If it's something that you don't necessarily understand or want to spend a lot of time doing, to be honest with you, that's why a lot of people hire someone like myself or another advisor, just so that way they don't have to worry about it. They want to go and be able to take their vacations and not have to be sitting on the beach and wherever it is and worrying about what the stock market is doing. You also don't know what you don't know. So sometimes it's nice just to get a second opinion. And I guess that's another thing that some people will do, and they will just offer to do like a retirement plan for you, charge a fee for something like that, to kind of see, well, where are your blind spots? Are we doing everything that we should be doing in your situation to get you to where you want to be? But there's plenty of people out there that I tell that, no, you probably don't need our help. Your situation, you've done a great job yourself saving, or you have other income that's going to cover the vast majority of your goals, expenses. You don't necessarily need an advisor. It's more so for the people that aren't willing, or they don't want to do it themselves, or they just don't necessarily want to deal with the financial side of things because it's not what they're good at. My wife is a third grade teacher, and she would not be able to handle our finances. I would not be able to go and handle a third grade classroom. So we do what we are good at, and what we enjoy. And sometimes it makes sense to pay other people to help get you to where you want to be in the big picture.
So I've heard that actually people who use financial advisors can do better in terms of their investments, et cetera.
Potentially. I mean, there's studies out there, like Vanguard has a good study. Russell has a good study out there that shows what is the added value of working with a financial advisor. And a lot of them, like the Vanguard study, Vanguard's very well known as being anti-fee, keep costs low, don't pay additional fees, but they're not anti-advisor. And what they did a few years ago was conducted a study seeing what does working with an advisor actually help add to a client's bottom line. They say the average advisor can help add about 3% to a client's situation. And a lot of that comes from the behavioral coaching, making sure that we're not making bad decisions, basically making sure that we're thinking through things and not letting short-term volatility impact our long-term investment strategy or retirement planning process. That's where it can really help with some of that. I've met with people that sold out of everything back during COVID, been sitting in cash for the last 4 years, and it's cost them $500,000 of bounce back growth in their investment accounts. Where if you have an advisor, you can kind of work through that plan to make sure that, well, are we set up appropriately, even if we do have some market volatility, so that way we don't have to negatively impact our future by some of the decisions that we're making in the short term based on short-term volatility in the markets. So it depends. The more your advisor can offer, the more that the value can be. If they're just investing for you and you're not getting anything else, if they're not making strategic changes, it may not necessarily mean that you need an advisor to do that stuff for you. There's plenty of places out there where you can go and do your own investing. But again, if you're going to do that, make sure you are comfortable and aware of what you're actually investing in, the upside as well as the downside risks associated with all of that, as well as any fees, charges, things like that, that custodian might charge for placing those trades as well.
Thank you.
So Rebecca has a question here in the chat. So if you are thinking about getting a financial advisor, starting investing, how much do you typically need to start a good investment portfolio? Is there a recommended amount to start the process of investing? So each advisor is going to be different. If you're going to work with a financial advisor, some places will have minimums on, if you don't have this amount, we're not going to do this for you. It kind of depends. Like I said, each and every place is going to be a little bit different. I would tell you that there is no set dollar amount that you need to get started to save or anything like that. The sooner you save, the better off you're going to be in the big picture. I have friends of mine that as they get out of school, I'm like, hey, even if you can put $25 or $5 a month away, whatever it may be, that will really start adding up and making an impact in the big picture. I go back and teach in Monticello. They have a class for the seniors called, I think it's life skills. There's a financial section there where they talk about investing. So my old teacher asked me to come in and just talk about, well, what are things people should be thinking of? And the biggest thing, I mean, these are all 17, 18-year-old kids. It's 8:30 in the morning. None of them necessarily really care about what I'm saying. But the big thing that I try to get into everybody's head, whether you're 25, whether you're 65, 85, the sooner you start saving, whether it's a small amount, whether it's a big amount, it doesn't necessarily matter. Just start doing something. There is no recommended amount. A lot of it's going to be based on what are you trying to do big picture with your goals. Some people need to save a lot because they have a lot of goals. Some people don't necessarily need to save a lot because their life, their situation, their goals, expenses may not be that big either. So not a great answer, but it depends on each and every situation.
You can sort of see that, to a flat fee-based compensation scheme, he doesn't care how much money you have, right? I mean, he's getting his fee just for giving you his advice, right? Whereas, I hear sometimes on the radio, these guys say minimum account size, $750,000. And it's like, if I had $750,000, would I need you?
Right.
I don't know. It's, that right there, it kind of a little discouraging to have somebody tell you we don't want to deal with little guys.
Yep. And they do that because, again, they're not going to make a lot of money on that side. On someone that has $75,000 compared to $750,000, well, they may not want to take up a spot in their book of business because there's only so many hours in a day in a year that they can spend meeting with people. So that's why they will have minimums. And to be honest with you, some people just aren't that great of advisors for people that don't have a certain amount. So sometimes they're what they do, their target audience has a certain level, and if you're below that, it may not make sense to use their services. So sometimes they don't even want to offer some of that.
Mm-hmm. So in your firm, do you which of these compensation schemes do you typically use?
So 99% of our clients work with us under the assets under management side of things. So we get paid monthly. It's an annual fee that gets charged monthly with our clients. And that's because most of our clients are 5 to 10 years on either side of retirement. So we're doing the investment management, we're doing retirement planning, talking about goals, talking about expenses, what their financial situation looks like. We have tax planning, we have our health insurance people. All of those other services are provided for in that assets under management. We don't charge people to come in and do a meeting. If you call me and we spend 15 minutes on the phone, I don't know if there's any lawyers or accountants on the phone or on the call here, but we're not going to send you a bill for 15 minutes of our time, things like that. It's typically all included under the assets under management side of things. But we do have a few clients that like doing their own assets or their own trip buying, selling, or they have someone else that does that for them, but they want more of the planning side of things. We can work with people under the flat fee based side of things, but we don't really do anything commission based outside of like life insurance because that's really the only way to do life insurance. They don't charge you, or they don't pay you for how long that client lives or anything like that. But there are times when the commission-based stuff makes sense. We have friends, people like that, hey, can you help me start investing? And I'm more than happy to do that with people. And I don't want to charge them a commission. So sometimes I don't charge the full AUM things, but there are other advisors in our office that every once in a while it makes sense to do things on the commission-based product. Like I said, if you're going to buy something, hold it for the next 30 years, no reason to pay an ongoing fee with some of that stuff. But 99.9% of the people that we work with are under the assets under management or the flat fee based side of things.
Mm-hmm. Feel free, anyone, jump in, take advantage of this opportunity here. Otherwise, I'll hog some more time.
So I have a question. So do you, when you give this talk to these young people, are there some basic things that you advise them to do? Like once they get a job, should they put money into a Roth, or what do you suggest?
Yeah. So, I mean, the big thing is, as soon as someone starts getting a job, if they offer any like 401k or company match, that's the first place that we tell people to kind of start. Because if they're going to match, if you put 3% in, if they're going to give you 3% of your salary, that's the first place to go and get that money invested, because it's 100% return on your money. If you don't do it, they're not going to pay that out. So you might as well take advantage of that as much as possible. So typically we start with the 401k match, and then really trying to start building an emergency fund. And sometimes the emergency fund needs to happen even before the 401k, just to make sure that if something happens to your job, if something happens to your income stream, you need to make sure that you have money set aside in a safe and a liquid place to help cover day-to-day expenses. We typically tell people between 3 and 6 months worth of expenses is what you should have in an emergency fund. So emergency fund and 401k up to the match are kind of 1A and 1B. After that, we talk about the differences between like a Roth IRA, traditional IRA, and like a brokerage account. Again, every situation is going to be a little bit different, but no matter where you're saving money, we tell people start early and make it automatic. Have it come right out of the paycheck, whether it's $25, whether it's $400, I don't really care. You're more likely to have that continue to happen if it's automatic. We have people all the time that take the money, it goes into their investment or into their checking savings. They say, oh, yep, I'm going to do my contribution later this year. And then they never do it because it slips their mind. And so biggest thing is just set it up, get it set up automatically. So that way you don't have to worry about it.
Sounds like good advice.
So if you're talking about most of your clients are within 5 or 10 years of retirement either way, that's a different type of management strategy than someone who's dealing with young people, right?
Exactly.
Are there firms that have, within your firm, do you have someone who's a growth specialist versus wealth preservation specialist?
Not specifically on that side. All of us as advisors are on our investment subcommittee team. So we kind of help make those decisions for each and every client. We can do that as each advisor. But as a company here, we have, I think we're up to about 15 advisors. We have a chartered financial analyst, a CFA, that is more on the investment side of things, that's kind of geared towards, well, how do we set these different pieces up? Because different advisors will manage assets differently. Some of them will only do individual stocks. Some will only do mutual funds, ETFs, things like that. And every situation is different. We don't do a whole lot of individual stock picking just because, like I said, most of our clients are within 5 or 10 years on either side of retirement. So we don't want to have the major risk of an individual stock. So we like to be a little bit more diversified. But there's no one specifically in our group that is just the investment person. Everyone in our group, and again, every situation is different with different companies, but everyone in our group will have that fundamental knowledge on the investments and asset allocation, depending on, well, are you growth oriented? Are you more conservative investor? We set up different models as kind of a core investment for our clients between aggressive, moderate, conservative. Sometimes it's an income stream type of portfolio there as well. So that makes a difference too on what is available for each of the clients is what they actually are able to offer on their end as advisors.
Okay, thanks.
Lucas,
Yeah.
can you hear me?
Yep, I can hear you, Judy.
I'd like to ask a question about helping my 14-year-old grandson better understand investing. And the old-fashioned, of course, approach to this was, well, open a savings account, you know, for people of my generation, certainly. But he's asking questions about stocks and things of that sort. And while I'm pretty well versed on, you know, a lot of the terminology, I found that he's not interested in, well, here's a book for a reference. You know, they're so oriented these days. There are options to, with a financial planner or someone, for a 14-year-old to begin to invest birthday money, for example. He's not doing any jobs yet, of course, because he's too young.
Right. Yeah, there's going to be options. Again, each firm, each company is going to be a little bit different on what they would allow. So like if it's like with our clients, what we do is if they have kids or grandkids that have questions, we like to set up like 20, 30-minute kind of slots of time every once in a while to be like, here, just jump on, ask some questions, talk about your situation. If there's things that you want to learn about, we can talk about that. But there's also a lot of like financial podcasts and things on content creators that will talk and provide financial education. Again, with some of that stuff, you want to be careful of who's actually saying it and what background and education, and if they're eligible to actually be able to talk about some of this stuff. So don't just always believe everything you hear on the internet or what you hear in a podcast, because that doesn't necessarily mean it's the best way to go about it. But I would say just having that conversation, talking a little bit about it, and if it's something that they want to learn a little bit more about, reaching out to an advisor just to talk through some of this stuff. Like our clients, we do monthly events with our investment clients that are educational based. So we do like a next generation investment like webinar each December that will kind of start at 101. Then the next year we'll go to 201 and kind of just talk about the basic and start building onto that for people that are interested in investing, talking about trying to get ahead of the game when they're younger and things like that too. So there's different events, different educational opportunities, things like that out there. Again, it kind of depends on what the advisor offers or what that firm will offer, but there's a lot of good resources out there.
Now, can I just clarify one thing?
Yep.
It's my understanding that a 14-year-old can't open an account, an investment account in his own name, that an adult has to be the initiator of that. But
yep.
Is that correct? At what age can they? Correct.
So if they're under the age of 18, you can open like a custodial account for them where you're the custodian, the kid or grandkid is the beneficiary of it. And then at 18, typically that will flip over to their ownership at that point. But yeah, typically you can't have them open up their own Roth IRA, things like that until they're 18.
Is that true of a savings account as well these days? I'm not really from Wisconsin, so I don't know.
That I'm not 100% sure on. I think a lot of times they will let you open up a savings account, but again, they're going to have someone on as like a co-signer or custodian of that until a certain age typically. But again, each place might be a little bit different. I don't know 100% what those rules are on that side.
Okay, thank you.
Yeah, absolutely.
Anyone else? Go ahead.
I have just 2 points quickly to make. First, Lucas, thank you for coming to talk to the group today. I really appreciate
absolutely.
Your input. I would encourage everybody, not just if you're starting a new relationship with an advisor, but even your existing relationships, to look them up on Broker Check. I think it's good to take a time to double check that you're still working with the same person you think you are, right? That things haven't changed, that there hasn't been a bankruptcy or a lien or some customer complaints that have cropped up. So Broker Check is really a valuable resource, not just for people getting into a new relationship, but also to check out your current relationship. And there's some other resources as well that are really helpful. One is us, the Division of Securities of the state of Wisconsin. We have a phone number for folks to call. They can call it the Examiner of the Day hotline. So either myself or one of my colleagues is always ready to talk to you. We're ready to answer questions about, hey, I'm going through this experience with my advisor. Is this typical? Or, just kind of bounce things off of you if you're seeing things that don't seem quite right. If something doesn't seem quite right with your advisor, we want to hear about it. We really want to encourage you to reach out to us and let us kind of talk about it. So we have a couple other resources also available. Our website just got recently revamped not too long ago. We have an investor education portion on there. So I'll put those links in the chat. But of special recognition, I think I want to point out we have an investor with a Wisconsin investor guide. It's a very comprehensive document that goes through a lot of questions that you might want to ask someone new, or to also kind of go through some common scams and things to help folks be aware of that. So I'll post those links in the chat. And yeah, thanks again, Lucas.
Yeah, absolutely happy to help.
And thanks, Joe, for bringing up those points. Really appreciate that. This presentation will be on our YouTube channel, and Leslie and I think it was Deb Fabritz and Joe who gave the presentation last summer. That's on our YouTube channel as well. And so, we've had so many good presentations. We had an estate planner who talked about power of attorney, which is something that a lot of people don't think about until it's too late. So review our YouTube channel again if you have time. Okay, well, we're kind of at the top of the hour. Any last minute questions? All right, well, thank you, Lucas, very much for all of the fabulous advice here. We really appreciate it, especially coming from your personal experience in this. I mean, you've dealt with a lot of clients, and it's very helpful to get that experience here. And thanks everyone for joining us today. The links that Joe's putting up are in the chat, and I'll leave the session open for you to get at those. All right.